Good morning and welcome to the Killik & Co podcast for Friday the 11th of September. It's been another fairly volatile week on global equity markets. On the economic front, we've had some further data out of China showing the economy continue to weaken there. And we've had some mixed data out of the US, including some quite strong data though in the employment picture. And we've also had some good data out of Europe. On the policy front, we had the Bank of England keep rates unchanged this week. And then we've had further expectations that we may see some further stimulus out of China and potentially also Japan. And then, of course, next week we have the Fed rate decision, and that's going to occupy the minds of investors next week. In terms of China, we had import and export data out of China during this week. In terms of the export data, it fell again 5.5% year on year in August. This was slightly less than had been forecast of 6.6%. This is a Bloomberg consensus forecast. But it was really the import data which caught attention. This declined by 13.8%. So this was quite a lot further, a bigger decline than had been anticipated, the 7.9%. And also it's a 10th consecutive fall that we've seen in this number. So this has raised expectations of further policy measures that we're going to see out of China. In terms of what they've done already, well, they've cut the bank lending rate quite significantly. As we can see here, the rate now is lower than it was during the financial crisis. And the August rate cut was the fifth rate cut that they have done since November. And so the expectation now is that they may move away to some degree from monetary policy and look back at fiscal stimulus to get the economy going. Obviously, this week is going to be a big week. The coming week is going to be big in terms of the Fed rate decision, and it's going to get a lot of attention. But before we look at what the market's expecting on that front, it's worth looking at the employment data that we had out last week. We had the US non-farm payrolls. The headline data showed the addition of 173 jobs added in August. This was below the estimate for 217,000 jobs. But I think we need to be a little bit cautious about how much attention we pay to this headline figure. Previous figures in August have tended to be revised up, and in some cases quite significantly. And also we had a revision to the two previous months' figures as well. I think probably more attention should be paid to the numbers we're seeing here, and this is the unemployment number. The unemployment number now fell to 5.1% at the headline figure. This was down from 5.3% previously, and also fell more than expected. The expected decline was to 5.2%, and it is now approaching the non-accelerating inflation rate of unemployment, which is the measure at which the Fed would look at which we're reaching full employment and pressure on wages will start to increase. The other interesting thing to note now is that when the Fed last started hiking rates back in 2004, the unemployment rate was is actually lower now than it was then, although the underemployment rate is still a little bit higher than it was at that stage. We had other data out this week which points to further tightening in the jobs market. And this is the job openings rate, which actually reached its highest level that it's been at since this data was starting to be compiled back in 2000. And this does suggest that firms are finding it harder to fill positions, and this could put further upward pressure on wages going forward. Just moving away from the employment picture just for a brief moment, if we look at some of the manufacturing and non-manufacturing data, we are seeing a divergence between the two indicators at the moment. The manufacturing data here, both of these metrics are still above the 50 level, which signifies that they are expanding, although we have seen a fall down in the manufacturing. This obviously is partly reflected because of the strength of the dollar is having an impact on this. But perhaps the more important metric for us is the non-manufacturing one. This is more the sort of the consumer side of the economy, and that's continued to be fairly robust. Remember that consumption is a very important part and by far the largest part of the economy in the US. So the consumer is incredibly important. And that we actually saw this level rise to 59 from higher than the 58.2 that had been expected. We did touch on this just briefly. The US dollar it clearly has had an impact on US multinationals that are exporting. It is a significant headwind for them. And this is something which the Fed is no doubt going to be taking into consideration if they do decide to raise rates. The divergence of their policy relative to the policies of other central banks could lead to further strengthening in the dollar and the potential impact that would have on some of the exporters in the US. So what's the market actually thinking at the moment? Well, the implied probability on the basis of the Fed funds futures has actually come down significantly. So the current expectation of a rate rise in September is now down to about 28%. And we can see how this has come down significantly. 6 months ago, the implied probability was almost at 80%. And even a month ago, we were looking at closer to 50% for a rate rise in September. There are another two, if they don't raise rates in September, there are another 2 occasions in which they could raise rates. There's a meeting in October and also in December. The expectation now is that they may not raise rates now in September and will probably wait for December in order to do so. The current expectation there is just shy of 60% on the basis of the Fed funds futures. Just looking ahead to some of the upcoming macro data, clearly the big one is, as we've mentioned, the FOMC rate decision. But we have some sentiment indicators coming out today, the University of Michigan Sentiment Index. And this will take into account some of the market turmoil we've seen. So it'll be interesting to see how that, the sort of decline in the wealth effect, if you like, from the fall in the stock market, how that offsets the sort of better employment picture and a strong property market and also low gasoline prices. Over the weekend, we've got further data out of China, which will attract some attention, industrial production and retail sales as well. And then during next week, we've got some inflation data out of the UK and the US and the Eurozone, and some of the unemployment data out of the UK as well. In terms of corporate news, very little news flow next week. For Killik & Co., one of the stocks which we do cover is Ocado, so we'll be looking out for that. And then also as a more sort of general sentiment and indicators, FedEx and Oracle Corp, sort of bellwether about the sort of general economy in the US. And then just to end, just to touch on a new theme note which has been put out by the equity research team. And this is online travel. It plays to 2 underlying themes. One is the growth in global travel, driven very much by demographics. And then also the increase in e-commerce, which is also leading to an increase in this part of the market. Online travel bookings are continuing to rise. They're already about 38% of a very large market, and this is forecast to continue to rise from that level as online travel agents do start to take more market share of the more traditional travel agents. In terms of how to play this theme, there's a TripAdvisor and Expedia. The team have put buy notes out on both of those stocks. And if you want a copy of those research notes, please do contact your broker. That's all from me today. Have a good weekend. Thank you.